I was gonna, as I hit the record button, John, I was gonna just wait long enough for you to finally give up and start talking first, but I felt like that might put you in an uncomfortable situation, so I won't do that to you this week. Welcome back to the podcast, everybody. Welcome, John. Welcome back.
No, I'm in kind of a groove. It's hard to
I
get out
know,
of
I
that
know.
groove.
I have this podcast that I've been producing for almost 10 years now, a little over 9 years, called The Nice Guys on Business. I've been hosting that podcast. We have 1,450 episodes, and every single one of them, with the exception of maybe a handful, have been with another person. Like, you do these things called solo casts every once in a while.
Right.
I don't, have you ever talked to like just a blank microphone? It's really hard to just talk to a microphone.
I do it every morning. I actually put out a morning 5-minute audio update. Yeah.
God bless you. I just don't understand how people can have a conversation with a microphone without getting any feedback. So we're gonna do something a little different today. We're going to talk about some of the assumptions that are made in financial planning, and we're going to take it from there. Talk about future projections. Talk about all the fun stuff that probably we might even dispel some myths about financial planning. So why don't you kick it off here, John, and then we'll tell everybody how to get in touch with John and his gang over at Guardian Rock Wealth. So why don't you share a little bit about what are some of the assumptions made in financial planning?
So I think that these assumptions, you know what assumptions make out of you and me, right? So we won't spell that out on the podcast, but you can spell it out on a napkin and figure that out if you're trying to figure it out at home. But they can be really dangerous, right? And we all make them, and from those assumptions we sometimes make decisions that may not be the best ones.
Mm.
And often, unfortunately, even in the financial planning sphere, there are advisors out there who, because it's just easier, they only go just below the surface and they don't dig deeper. Well, one of my many phrases is, well, let's dig a little deeper. My kids will tell you that's another one of my phrases that I use all the time.
Let's poke the bear a little bit. Let's do it.
Uh-huh.
Let's poke the bear. Poke the bear a little bit.
Right, exactly. And I think one of the most common things that I see, and frankly, one of the more common reasons that people come to us at Guardian Rock is they've recently had an advisor or advisory firm that caused them to have something go wrong inadvertently, but because they weren't thinking beyond making a higher return or something like that. So have you budgeted, like we talked about a little bit ago, is Social Security tax or your 401k tax? Have you thought about that cash flow and you see, oh, I'll be able to generate X number of dollars from my 401k, but remember those dollars are taxed. And in most financial planning softwares, that budgeting for that tax amount isn't even in there, even
Wow.
in the software that's out there. So keeping in mind how things are taxed, and preferably coming to somebody like myself at Guardian Rock, at least, please come a lot earlier than this, but at least 5 to 7 years before you're actually planning on retirement. To do a little planning can save you hundreds of thousands of dollars in taxes. And forget about the returns that we might be able to generate for you. Forget about that. What can we save you in paying taxes?
Mm-hmm.
And that again is that 4-letter word, does involve some math and digging a little bit deeper.
Talk to me about a little bit about the money that you're going to need in retirement. You wrote a comment in the information that we were going to talk about. Trust me on this, you will not need just 85% of your pre-retirement income in your first 5 to 10 years of retirement. Tell me what that means, because I think that this is an impactful statement that you made.
Yeah, so this is a statement that I hear all the time, and that I've seen other financial advisors, and they can be mad at me when they listen to this and tell me I'm crazy. But in my experience, this whole myth that, oh, you know what, you can live on 85%, or some other people say 90, whatever your percentage is. but it's less than 100% of what you're spending now when you're working. I have not found that to be true at all.
And why is that the case? I can think about a few reasons, like you have more time.
You have more time.
You want to do more things that you couldn't do when you were working. So for me, that means more vacation, more time out of the house, which means spending more money.
That's right. And you have this pent up desire you've been waiting for. I know. So my wife and I, right? We have 6 kids. One of them is still in the house, getting ready to graduate here in another year after this one. And frankly, this idea of an empty nest, first of all, is financially exciting. But the other thing is there are just things that we will be able to do that we just cannot do yet.
Right.
So we there's a pent up demand. And by the way, we're saving for that. And that's going to be before we retire, because I don't plan on retiring for a long time because I like what I do. We've talked about that.
Mm-hmm.
But there's still going to be some stuff that we can do. Like we had an opportunity to go on this really cool trip to Morocco, of all places, at a really nice rate. But we can't do that. We can't leave for 3 weeks and go to Morocco with a 17-year-old in the house unless you've got an amazing 17-year-old. I don't think that's a good idea.
Understood.
So, I mean, things like that. And that's the same way in retirement. There are things that you just wouldn't do or feel like you can't do that you're waiting, even if it's subconsciously, you're waiting. And guess what? Most of those things cost some money.
What's another assumption that people have when it comes to financial planning?
Another assumption people have in terms of especially retirement expense is when you stop getting paid by your company, it can be fairly shocking. There's a lot of sticker shock that goes into your healthcare costs. And yes, there's Medicare, and which is a whole nother topic. And actually, I'll probably bring somebody in. We should do that. Bring a Medicare specialist, because a lot of people try and do that on their own, or they get at 64, they get a stack of mail 5 inches thick and they don't know who to trust to get them that. Another thing that we provide is people that we know, like, and trust, that are just, that's all they do all day long, is help people plan for their Medicare and do it, set it up right to begin with, so that you minimize your costs but maximize your benefit. That's a whole different topic. But even then, it can be kind of a shock in terms of how much your medical costs go up. And unfortunately, as we get older, medical costs tend to increase because things start not working like they are supposed to.
just from a self-employment perspective, I know that, you know, my son works for a large company, and he's like, well, and he's a young guy, and he's like, oh, health insurance only costs me like $60 a pay period. He has 2 pay periods a month, so it's $120. They said, no, they're covering about 90% of your healthcare premiums through that's just your small little portion, and you probably still have a deductible. But then if you step into self-employment, you take care of all of that on your own. Geez, $1,000 a month is not uncommon for a single person, you know, double and sometimes even more if you have a family that you need to cover on your own healthcare premium. So just be aware, John is 100% truthful with that. It is a shock if you have to cover your own healthcare expense.
Yeah. You know, speaking of that, I just talked with a client 2 evenings ago who opened up to me that he is not he wants to retire, but he is not retiring because although he is 66, his wife is only 62 and doesn't qualify for Medicare, and he's carrying the insurance. And I always hate to hear that, when living your best life is really retirement. That's the answer, but you're only working for the cost of health insurance. So we're going to fix that for him. By the way, I've got some solutions working with some of our healthcare providers that's part of the financial plan. That's part of what you get when you work with Guardian Rock. You don't just manage your money. We help you manage everything around that, from your taxes to insurance, to health insurance, to property and casualty insurance, to estate planning. life insurance, all of that is a sort of a one-stop shop. Not that we help you with it all, but we bring people in who are experts to help you with that. We're going to suddenly, he didn't tell me that he wanted to retire right now. He had told me, oh, I want to retire in 4 years. But what did he not tell me? He didn't answer the question why until our second meeting. And when he answered the question why, was he still working? It was because of this. Well, that's something we can solve for. And he was just afraid of it. He hadn't done the research. He didn't know. But you can solve for a lot of problems. So rather than just sit there and be afraid and do nothing, give us a call.
All right. One of the final assumptions that you have in financial planning is what portion of your retirement income will be tax-free. I wasn't even aware that you could have some tax-free portions of your retirement. So how does that work? And then we'll wrap after that.
Yeah, and that is a really common misconception, is that you can't get tax-free income, and there's really only two ways to do it. So it's pretty simple, right? There's only two ways. One is through a Roth IRA or 401k, and the other one is through what we call a LIRP, which is just another acronym. Sorry, I try not to use those, but it's a life insurance product that allows you to contribute in a very specific way over about 7 different periods, about 7 years. So you do need some time, some planning time on this. And then in retirement, I won't go into all the details of how it is set up. In retirement, you can borrow from the cash value of that. Any borrowings are tax-free. And then at the end, when you no longer need it because you have passed away, death and taxes, the two things that are guaranteed in life, right? Then your heirs, whatever is left in the life insurance benefit, of course, life insurance proceeds are not taxed. So those are the only two ways to do it. And they require some advanced planning and some math.
There's that pesky little 4-letter word again, John. You brought that up in the last 3 episodes. We'll leave that to you and your clients or prospective clients to do the math when you guys get together. What is the best way for someone to reach out to you to either have a meeting or just find out more information about what you do and how you do it?
So Guardian Rock Wealth with a th.com in the contact us section, great way, or text the word life to 321-421-5213. Those are the two best ways. And when you text that number, you're just going to get our digital business card, which has links to all kinds of free information for you. So if you never want to contact, you just want to take advantage of the free stuff there, you can do that. Or down at the lower right-hand side, you can schedule some time directly with me.
All right, do the math with John. He will do it with you, and I promise the math will always come out right because he knows how to do the math. So, John, thanks for sharing today. Thanks for your wisdom and your expertise on the show.
All right, sounds good. We'll see you next week.